We continue with our discussion on advanced equity valuation techniques, and in this particular set of videos, in this video we're going to discuss about primarily M&A, mergers and acquisitions, and what do mergers and acquisitions basically do, and how can we derive the value creation that happens because of an M&A activity, right? Or value creation or value destruction, whatever is happening, can we try and identify if the merger and acquisition is really creating any kind of value for the companies under consideration, right? That's the idea that we are looking at, right? Now, most mergers and acquisitions are justified with the argument that the larger combined entity will be able to kind of take advantages of synergy benefits. What is synergy? Synergy is any potential benefits that can come out in the combined entity, which in the individual entity may not be available, right? It is therefore important to understand if this synergy could be valued somehow, or if not valued, at least could it be quantified somehow, right? What is the value of this synergy? Now, synergy could either be operational in nature or financial in nature. We will look at this distinction in detail as to what does operational synergy mean and what does financial synergy mean. But this would largely play in terms of cost savings in most cases. And this would largely play out in terms of either tax benefits or in terms of better usage of cash or in terms of debt cost going down kind of things, right? In most cases, the idea is that the target company has some kind of resources which may be put to better use by the acquiring firm, and this would create the synergy. The idea of the synergy is coming from the fact that the target company is essentially in control of certain set of resources which it is not able to utilize better today, but probably when the combined company becomes together, these resources would start getting utilized better, and that's the idea. Now, what could these synergy sources be? First, let's understand the different kinds of mergers and acquisitions. Acquisition is when one larger company acquires a smaller company, or a company takes control of another company. Sometimes smaller companies can acquire larger companies as well, right? Merger is when two equal companies get together and a combined entity is formed, right? So in case of acquisition, when A acquires B, it's at the end A. In case of merger, when A and B merge, the ending entity is AB, essentially. That's the nature of the transaction that happens. Now, there could be three kinds of M&A activities. It could be horizontal M&A. Similar firms in the same kind of market combine. Primary sources of synergy are economies of scale, which reduce costs, or from increased market power, which increases the profitability and sales, right? The example would be the proposed idea Vodafone merger. This basically is an example of two similar companies in the market combining together horizontally, and primary sources of synergy would be the fact that both of them combined would have a larger market footprint and their costs would be lower, right? Vertical M&A is basically acquiring something in your value chain itself. So if a steel company acquires a supplier like a coal mine or an iron ore mine, this is a vertical M&A. You're trying to acquire either a supplier for you or a customer for you, essentially, in your chain of business. And the synergy is due to better control of the value chain. You are saying that I can control the value chain slightly better, right? I can control the raw material cost. I can control the way my product is being shipped out from my business. That's basically the idea of a vertical M&A. Then the third could be a functional integration where two different kind of businesses combine. Now there may be no direct link, they may not be in the same market itself, but they are trying to leverage some common drivers, right? Just as a hypothetical example, let's say a retail company may go and acquire a social networking company in order to leverage its network. There is a network that something like, let's just argument's sake, Facebook has created. Tomorrow, someone like a Flipkart or an Amazon might want to kind of get hands on something like this so that they can address using the technology or using the network, they could probably increase what they are already doing, right? So that's a sort of a functional integration. It is not similar companies, but companies which might be catering to similar kind of customers, right? common kind of customers. So you're trying to kind of tap into the customers of another company, and the idea basically is that those similar drivers, those similar common drivers could be utilized, right? Now let's understand what is the figure understanding of operating synergy and financial synergy. When we talk about operating synergy primarily comes because of economies of scale, better utilization of the resources that are there because two companies are combining. Cost savings will get because of that. Even in our discussion around Ultratech acquiring the cement plants of JP Associates, the idea was basically that JP is probably not able to utilize them well. When Ultratech acquires those plants, because its capacity increases, because it has a wider footprint pan India, economies of scale would make the same plants profitable, cement plants profitable, because they will be able to produce at a lower cost, right? Operating synergies could come because more new investments could come in, right? Because of growth that opens up. And typically, it would also result in higher returns on investments. So, effectively, your operating synergies would mean better investment opportunities and consequently better returns on investments or higher returns on investments. So, when you see this, there would be a direct impact on certain parameters, and we'll understand those parameters as we go along. On the other hand, financial synergy could be either in the form of tax benefits. Let's say there are two firms, A and B. B is a loss-making firm. Now, because it's a loss-making firm, there is a tax advantage it creates because of its losses, right? Losses are not taxed and you can carry forward and set off profits against that. But B is unlikely to make any profits on its own. Now, when A combines with B, this loss or the existing advantage of carried forward losses for the last few years, which can be set off against the combined entity's profits for the next few years, that adds up here. Otherwise, in itself, B would not have been able to kind of utilize that, right? There could be added debt capacity when two larger companies combine, when two companies combine to form a larger entity together, then essentially we are saying that the debt capacity could increase. The combined entity would have better access to resources, and hence banks would be more comfortable kind of giving out higher debt, and consequently you would see lower cost of debt in this scenario, right? Because of the combined capacity of the two companies getting together. The third is better utilization of cash. Let's say A is cash rich, right? And B does not have D. B has a lot of projects. B has a lot of projects, but does not have cash, right? When they combine, this cash can be used in these projects. Otherwise, A was not able to find any kind of projects, right? So essentially, that could be a better utilization of cash, and all these are sources of financial synergy. Direct cost or return on investment advantages are operating synergies typically, right? Now, how do you value synergy? To value synergy, first, the firms in question, let's say there are two firms, A and B, they will be valued independently, right? So you do A and B, and then you kind of find out A plus B. Separate entities do the valuation, detailed valuation, either DCF or relative valuation, whatever, but combined. The combined entity is then valued. So now you are valuing AB combined together using assumptions about all the effects of synergy in terms of economies of scale, lower cost of capital, higher return on projects, whatever you want to kind of look at in terms of lower cost, better margin, lower discount rates in the combined entity, you could do that and then try and find out what is the value of AB. Now the difference between AB minus the combined value independently valued A plus B is basically expected to be the value of the synergy. If you do the valuation, that is essentially what is your synergy value. AB minus A plus B is your synergy, right? Now, what typically would be the effects that you would see in your models that you create? If synergy is due to economies of scale, usually operating margins will expand. Why? Because costs will go down. If synergy is due to higher growth opportunities, right? There is bigger growth that is happening in various segments of the companies. Then you will typically see that the combined entity over a period of time will show an increase in both the return on equity and return on capital employed, right? If the synergy is due to any kind of tax benefits, then automatically over a period of time, the effective tax rates would be lower, right? Finally, if synergy is due to a better borrowing capacity, then cost of debt will go down and consequently weighted average cost of capital will go down, right? In mergers, you could probably have a combination of some of these or all of these present. So it's quite possible that it's not just one single entity or thing that you're looking at, but possibly the combination that's happening because of the entire set of entities that's coming out, right? Now let's try and understand a simple example and see how we are going to value it. Let's assume there's a company A and there's a company B, and we're going to value it based on enterprise value to EBITDA, right? Now let's assume A has sales of 100 and costs of 60, which gives an EBITDA of 40, right? B has sales of, let's say, 200. B has costs of, let's say, 100, and that gives an EBITDA of 100. Now let's say, argument's sake, these two firms get a certain EV by EBITDA here. And let's say the EV by EBITDA is 5 times. So EV by EBITDA is 5 times. So that gives a value of 200 here. That gives a value of 500 here. So that's the enterprise value to EBITDA. Let's assume the net debt of firm A is 100 and firm B is 200. So when you subtract the net debt from EV, you will get the equity value, right? So equity value is 100 here, that's 300 here. Now you combine the firms. When you combine the firms, let's assume two things happen. One, sales is 300, so this is AB. Cost, because of the combined network, of these two firms, some of the costs which both of them were taking, for example, let's say there was a freight cost where both were separately sending two trucks, they will combine those. Employee cost might get kind of combined. Marketing cost would probably get combined. So what will end up happening is this will not be 160. This will probably fall to, let's say, something like 130. So what is left? 170, right? So the first thing that happens is 170 is left. Because of this, you can also assume an expansion in multiple, but we are not expanding that here. So let's assume the same multiple applies. So your enterprise value to EBITDA is 5, EBITDA is 170. So what will happen is your enterprise value is 850. Now, because the two entities are combined, it is also quite possible that you might be able to repay some of the debt because some of the assets may be duplicate. You don't need two offices. You may not need a lot of the things that are combined for individually for both the firms. So you'll sell it and probably repay some of the debt. Let's say the combined debt is not 300, 100 plus 200, but something like 250. So what happens to the equity value now? Now, when you combine the equity value here, that's 100 plus 300, which is 400. But here the equity value has become 600. And this increase is basically how you value synergy, right? That's an example of synergy valuation. This increase is an example of synergy valuation. And that's what basically we are trying to kind of say in terms of the overall context of things, right? That's basically how you go about evaluating synergy. Uh, let's take an example of a live set of data about companies. Now, we are already in the middle of this discussion of a proposed idea Vodafone merger. So the combined revenues of these two companies at this point of time, if you see, rupees billion 369 for Idea and 447 for Vodafone. This is all taken from this website Live Mint. So the combined entity will have a revenue of this. This is assuming no increase in revenue, right? But costs will go down. So what will happen is EBITDA, which is individually, if you add this up, is 244, will actually increase to 331. So that's an example of economies of scale playing out, right? Very clearly, they might have similar infrastructure, marketing, you might have towers that you're using that results in individual operating margins to kind of give way to a bigger this thing. And what's happening is they're adding operating cost synergy of $1.3 billion expected in the fourth year after merger. So this is basically an expected sales number in the fourth year after the merger, right? Then what does it do? It creates a market leader in almost all markets. So it gives you a better growth potential. It gives you better pricing power because you are a market leader now, right? So what happens here? You see, this is the merged entity, the blue one, and in almost all major circles, your metros, the larger A circles followed by B circles, the merged entity becomes the market leader, right? Based on revenue market share in October to December 2016 quarter. And that has significant advantages. Basically, the second and the third largest entities. So this is 2 and 3, they are combining together. This is 2 and 3, they are combining together. This is 2 and 3, they are combining together in almost all the areas, right? So that's going to be a very, very big advantage that that starts playing out. So overall, this will become India's largest, on a total level, this will become India's largest telecom firm. And that itself has a huge advantage that plays out, right? Look at what happens to net debt. Now, asset sales and synergy benefits will reduce leverage. Their current net debt is 527. Net debt here is 552. When you combine, this should add up to 1079. But because they are going to be able to sell some of the assets which are not needed, this in the merged entity will result in a lower debt because you will repay some debt by selling those assets. Asset sales will allow you to repay debt, right? EBITDA is going to increase. So when you calculate this ratio called net debt to EBITDA, which is 4.6 and 4.3 here, that improves significantly. Why? Is because effectively EBITDA increases, net debt goes down, right? And so that's the advantage in terms of your better profitability and better ability to service debt. When you have a better ability to service debt, automatically your cost of debt is going to go down. This is effectively saying that the credit rating of the combined entity should improve. If the credit rating of the combined entity improves, logically cost of debt should go down. If cost of debt goes down, WACC should go down, right? Because leverage goes down, because debt equity of the combined firm goes down, we also know that your levered beta should go down, right? Levered beta should go down, and that's a significant advantage that could play out in this context, right? Finally, let's look at what we did earlier with our sample company. There is a net debt number that is taken. There's an equity value that is taken, right? But equity value in the final case, this is a derived value. Let's understand how. So the enterprise value of the company today is 722 for Idea and 828 for Vodafone, right? When you look at EBITDA, that's the EBITDA. And so the EV by EBITDA ratio works out to 6.33, 6.38. Now, if we assume an average of this, which is 6.35 for the target company, and we assume that EBITDA for it would be 331 4 years down the line, then effectively the enterprise value can be calculated as this. From enterprise value, if I subtract the net debt, EV minus net debt, that's going to give me the equity value. And now look at what happens to the equity value. If you look at equity value here, that's 195 and 276. You add these together, this is approximately 470 odd crore, right? 470 billion, sorry. That's the equity value, 470 billion. The combined is more than twice. That's about 1100 billion, right? So that's the difference in the equity values. And logically, that would have a significant advantage in terms of value creation, assuming, of course, that the leverage reduces, higher margins materialize. It's also quite possible in real market that while they combine, this higher EBITDA does not happen because other firms keep spending money and other firms keep undercutting prices. That's a different issue. But when you're calculating it, the value of synergy is nothing but the difference between the combined value A plus B and comparing that with the merged entity, which is AB, 1100 billion, right? That is basically the valuation of synergy. In real life, it is difficult to say whether synergy will be materialized, it will not be materialized, people will be able to take advantage. Historical evidence says that it is very difficult to take advantage because most acquisitions end up overpaying for the stuff, right? In this particular case, however, what we are seeing is that synergy may get materialized because of economies of scale as per the data given on these websites. We're not sure, we'll see what happens, but that's exactly how you would try and estimate synergy in the context of a company, right? That's how you value synergy. That's it in this particular video. Before we close, a couple of quick questions. What are the various ways you could, explore synergy in a merger? And how can we value the potential synergy in a merger? Thank you.